And Ottawa announced today that it is implementing new tax changes come January 2018. Our next guest says small business owners need to consider how these changes are going to affect their ability to save for retirement. As part of our Small Business Week coverage, joining us now for more, Jean-Pierre Laporte, CEO of Integris Pension Management. Jean-Pierre, good to be with you today. Thanks very much for coming in.
Thank you.
Let me first get your reaction, though, to what we are hearing from the government with respect to these small business changes and listening to what's going on and maybe making some changes. What's your assessment today?
Well, I think it's a good news and bad news story coming all at once. The good news, of course, is that the tax rate is coming down for small businesses on the first $500,000 of corporate income. However, the bad news is that if you were thinking of using your small business as if it was a pension plan, you're going to be facing much higher taxation. So the government wants to dissuade people from using their corporation as if it was a kitty for retirement. And that's the big bad news part of it, because that's exactly what people have been doing for the past 25 years.
And your business comes in and tries to supplement a small business's pension plan or retirement plan. How is that?
Well, in fact, most small businesses do not have any kind of form of pension plan. And Statistics Canada recently released some information showing that the coverage is going down in the private sector. So it's bad news. The good news is that individuals can, if they want, set up a personal pension plan and therefore save like a civil servant or a teacher. They have the ability to have a gold-plated pension plan funded by their own business, which means that when the corporation makes contributions to the pension plan, they claim much higher tax deductions than before, than you would with an RSP, for example.
Right, but not to the same degree as if you were allowed to save and invest your money within the company in terms of this passive investment like the government is going after.
That's what the Minister Morneau is saying. He's saying, do not use your corporation as if it was a pension plan. It's not designed for that. It's meant for plowing back the monies into the company, hiring staff, buying inventory, not to passively invest in GICs or stocks or bonds.
But let me ask you this, because why do you think this is what your company provides small businesses with, right? The opportunity to have a personal pension plan. That's where you and your team come in to play here with the small businesses. My question would be, it's only about 2% of small businesses that actually use this personal pension plan. If it was so strong of a vehicle, why wouldn't more use it?
Well, we're not advertising like the banks or the insurance companies, so it's through shows like this or word of mouth that the forward-thinking advisors in the country learn about us and talk to their clients. So it's a slow process. It takes time. We've only been around for 5 years, so it takes time for people to learn about a new product, trust it. But I think we're seeing an exponential growth in our sales because people are catching on, especially with the new tax measures.
Talk to us then a little bit about this plan that maybe a lot of small businesses don't know about. What is it like? How do you get going with it? How much does the company actually have to contribute for this to be a viable product?
It's actually it makes money from day one, because what happens is you have access to 7 additional tax deductions that you don't have with an RSP. And when you tabulate all of the tax deductions, you get a tax refund or tax savings. So it pays for our fees many times over from day one. So it puts money in your pocket right away.
How are there 7 additional tax deductions?
It's because pension laws are a lot more generous than RSP laws. They've been around since the first Income Tax Act in 1917, whereas RSPs came out in 57, and they're just more generous. You can buy back past service, you can deduct your investment management fees, which you can't do with an RSP. You can also, even if you retire early, you might be able to contribute, I've seen up to $1 million. That's tax deductible to the business, going into your pension plan so you can retire early. I mean, those are unheard of in the RSP world.
Right. But I suppose, again, I go back to the fact that these small businesses probably find it a little bit easier somehow, or a lower cost offering to do this within their own company. And therein lies this debate that we're all having.
Of course, if you don't have enough money to make operations, run, then you're not going to be saving in anything.
Right.
Okay? But if you do, if you're, let's say, you're a dentist, a doctor, an accountant, a lawyer that's incorporated and has a stable revenue, then something something like this makes a lot of sense because if you don't, you're going to be taxed heavily.
Well, Jean-Pierre, I think that that's one of the areas, though, where this is so difficult in terms of there's not one model that fits all, because small businesses are different times of the life cycle of a business. If you've got a very small business whereby, you know, maybe it is cyclical nature, it doesn't even have to be a small business to be cyclical in nature, but you're going to have these operational costs that could be increasing. I think it would be very difficult for an owner-operator to say, I'm going to create this personal pension plan within my company and dedicate this amount of money to it when I don't know if the business and the economy is going to allow me to continue to do that, and I don't need some rainy day money. Is that not a fair argument?
I'm not really, because the personal pension plan offers you the ability to contribute as little as 1% of salary, all the way up to 26% of salary. So if you have more money, you can put more in. And if you face a bad year, you can even reduce your accrued benefits and walk away from any deficits. So there is a way, there's two escape hatches that are built into the system that we design for business owners because of the cyclical nature of small businesses.
Give me a little bit more detail in terms of that escape hatch. If in fact you need some of that money to fund your business, is that allowed or
yes,
no?
You can do
or
what's
where's
called
the tax
yeah.
impact?
So you can do a surplus withdrawal application. You can extract money out of the pension plan and send it back to corporate coffers. So that would be taxable in the hands of the corporation. However, if the company has losses, it can offset those losses against the profits or the gains, and therefore have the cash without the tax. So it's a way of sending back money to the corporation if you really need it.
Okay, because I think that's one of the biggest issues with respect to these tax reform changes and people who feel that they really need this money in the bank account just in case something happens.
That's right.
Which is a fair concern.
Yeah, it is a fair concern, but we've engineered flexibility into the product because we know that it's exactly what they need.
Okay, Jean-Pierre, good to be with you today. Thank you very much. That's Jean-Pierre Laporte, CEO of Integris Pension Management.